I'm Rick Kaler. Thanks for joining me. Planning is important for all things financial, and that includes retirement, which is inevitable no matter how far into the future that it might seem. The financial decisions that you make in your 20s through your 60s are going to greatly impact the quality of your lifestyle during retirement. Social Security and family are not going to be enough to get you through 25, 30, 35 years of retirement. If you haven't worked for a branch of the government, you're going to rely heavily on income that you've stashed into 401ks and IRAs. One of the big advantages of a traditional IRA or 401k is being able to save pre-tax dollars and let them grow tax deferred until you need them. Hopefully, when you take the distributions in retirement, you'll be in a lower tax bracket than when you made the contribution. The downside is that traditional IRA funds become 100% taxable when you withdraw them. Deferring distributions from your IRA only works until age 70 and a half, when you'll be forced to take the money out whether you want to or not. This is called the RMD, or required minimum distribution. If at age 70 and a half you don't need to withdraw funds to live on, but you're faced with an annual RMD, there's several things that you can do to minimize your tax hit. The easiest thing is don't stop earning an income if you have substantial 401k assets. That might sound confusing, but employees are not required to take RMDs when they're still working, even part-time. This is something that just applies to your employer's 401k. You'll still need to take RMDs from your personal IRAs or 401ks and IRAs from previous employers' plans. However, if you plan ahead, you may be able to bypass this. If you have IRAs that are rollovers from previous 401ks and they've been kept separate, your employer may allow you to roll them into your current plan. By consolidating previous qualified employer plans into your current plan, you can defer taking an RMD until you quit working. Another thing is, if you give to charities, you can give any portion or all of your RMD to a charity and not pay taxes on the distribution. This can really save you a lot of money if you're currently giving to charities out of taxable accounts. When you turn 70 and a half, simply redirect your charitable giving from taxable accounts to your IRA. You can give up to $100,000 annually without paying taxes on those distributions. Another strategy that we commonly use with clients is converting traditional IRA funds to Roth IRAs. Money in a Roth is not subject to RMDs. Of course, the downside is that you must pay taxes on the funds converted from your traditional IRA to a Roth. For a conversion to make financial sense, there's two important factors you need to remember. You generally want to do a Roth conversion when your current tax bracket is lower than you anticipate it will be in the future. Now, the most obvious scenario here is when you delay Social Security until age 70 and you are currently in a 10 or 15% bracket. It's highly possible that Social Security and RMDs all kicking in at the same time may put you into the 25% bracket, especially if you're single. Moving as much money at the 15% bracket prior to age 70 can make a lot of sense. It's also important that the money to pay the taxes comes from a taxable account, not the IRA. As with all financial strategies that are crammed into a 600-word video, there are variations and nuances that I'm not able to go into. If you think one of these strategies may apply to you, first, don't do it yourself. Don't try it on your own. Get some advice from a competent tax advisor or financial professional to make sure that you dot all the I's and cross all the T's. Thanks for listening.